Welcome to Ind AS channel on YouTube. Ministry of Corporate Affairs has issued Ind AS Amendment Rules 2018 while MCA notification dated 28th March 2018. These amendments are effective from 1st April 2018. The objective of this webcast and video is to give you brief overview of the changes proposed and effective from 1st April 2018 relating to Ind AS. If we just look at the standards which are amended by way of Ind AS Amendment Rules 2018, first is on Ind AS 40 investment property, then Ind AS 21 that is on foreign exchange rates, Ind AS 12 income taxes, Ind AS 28 on equity method of accounting for investment in associate and joint venture, Ind AS 112 disclosure of interest in other entities, and Ind AS 115 that is revenue from contract with customers. Out of these all changes, the most important changes are for Ind AS 21 and Ind AS 115. Let us take a brief overview of all these amendments to understand the impact and also to understand which steps are required for corporates to comply with these amendment rules. First, Ind AS 40 investment properties. The most important change for Ind AS 40 investment property is with respect to the paragraph 57 of Ind AS 40. Before this change, it was not clear that in which cases one can transfer from and to investment property. Para 57 earlier used to mention that the transfer to or from investment property can be done, or when and only when to be done, when it is evidenced by. So there are examples, there are illustrations, there are situations given in para 57, and only in that situations one can transfer from or to investment property. The question which was there, which was raised to IASB, was that whether the property under construction or development that was previously classified as as inventory could be transferred to investment property. Now, the the situations which are given under para 57 does not include the case of transfer from inventory to investment property. However, it includes a case of transfer from investment property to inventory, as the para 57 was clearly worded as only in the following situations you can transfer, which does not include any other cases. This has been now clarified by way of amendment under Ind AS 40 that the situations given in para 57 are only examples, and there may be more situations wherein it may qualify to be transferred. Now, what is required is, first, it meets or ceases to meet the definition of investment property, and the evidence of change in use is there, then you can transfer in or out of investment property. The transition provisions which are included under Ind AS 40, it gives you two options. Either you can apply retrospectively in compliance with Ind AS 8, or you can apply from 1st April 2018, that is effective date of these amendment rules. Second change, and one of the very important change, is Ind AS 21, the effects of change in foreign exchange rates. There has been a confusion regarding the transaction date to be selected for the purpose of the any amount which is received or paid in advance. Let's take one example to understand. A company has made sale of $1,000. Now the purchase order was entered on 10th March 2018. As per the order, the transaction amount is $1,000. 50% amount was received on 10th March. The goods were dispatched on 15th April. So the company has received $500 as advance from customer for goods to be delivered in the next year. Now this $500 which is received in advance, it is non-monetary asset as per Ind AS 21. Now as it is a non-monetary asset, it is not to be remeasured or translated at a closing rate, and it will stand as the same date exchange rate of the receipt of amount. Now on 15th April, when the goods are dispatched and sale is recognized, at that time exchange rate is different. So the question was that how to recognize sale, whether the transaction date exchange rate of 15th April or any other. This has been responded by the amendment in Ind AS 21 with the help of two concepts. One, it is always mentioned that it is a one transaction approach versus multi-transaction approach. When the sale is made and the advance is received, with the advance receipt and the dispatch of goods, they both are the part of one requirement of sale. So when the advance is received and when the goods are dispatched, they both are the transaction date for the purpose of recognition of revenue. In the case given where $500 have been received on 15th March and the exchange rate at the time was 50 rupees, the goods are dispatched on 15th April but the exchange rate was 52 rupees. So the sale need to be recognized on 15th April at the exchange rate of 50 into $500, that is the exchange rate when you receive the advance, and plus 52 into $500, that is the exchange rate as on the date of dispatch of goods, date of recognition of sales. So these two dates are required to be considered for the purpose of recognition of sale. Now this amendment is applicable not only to the sale of goods or purchase of goods, but also for the case of property, plant, equipment, intangible assets, investment property, inventory, services, entering into lease contracts, or in case of the some government grants. So this is going to be applicable wherever you received or paid in advance and the transaction is in a foreign currency. Second question was that in case of multiple payment or receipt in advance, then every payment or every receipt and the transaction date exchange rate on that payment receipt has to be considered. For example, in earlier case on 15th March, 50 rupees was the exchange rate. On 18th March, again I received $200, exchange rate was 51 rupees. And on 15th April, when I dispatched the goods, exchange rate was 52 rupees. So I will recognize sale $500 at 50 rupees, $200 at 51 rupees, and remaining $300 at 52 rupees. So at every multiple level, one has to recognize this transaction date exchange rate for the purpose of recognition of revenue. Transitions, again, it gives you two options. You can apply these retrospectively in compliance with Ind AS from the beginning or prospectively to all the transactions which happens on or after 1st April 2018. Third change is with respect to Ind AS income tax. As we all are aware that under income taxes, the Ind AS requires the temporary difference approach as a difference between the tax base of asset or liability and the carrying amount of asset or liability. So the question which was raised was that in case of fair value, where the asset or liability is modified, whether one need to create a temporary difference and defer tax asset liability on that amount. The standard says yes, you do create, but the illustration has been amended and added to para 26D. Let us go through the illustration. Entity A purchases for ₹1,000 at the beginning of year 1 a debt instrument with a nominal value of ₹1,000 payable on maturity in 5 years with an interest rate of 2% payable at the end of each year. The effective interest rate is 2%. The debt instrument is measured at fair value. At the end of year 2, the fair value of the debt instrument has decreased to ₹918 as a result of increase in market interest rate to 5%. It is probable that entity A will collect all the contractual cash flows if it continues to hold the debt instrument. So the carrying value of the debt instrument is 918. However, the tax base will remain same at 1000. So there is a difference between these two. It is called temporary difference. And with these illustrations, it has been clarified that the temporary difference need to be created. Second very important clarification which is received is that the assessment of deductible temporary differences and estimating the probable future taxable profit against which this DTD are allowed, they both are two separate steps and one need to apply these conditions and criteria which is laid out on Ind AS 12 separately for assessment of DTD and for estimation of probable future taxable profit separately. Next is on Ind AS 28, investment in associates and joint ventures. The main important difference or adjustments or amendment here is that it has been clarified that one can measure or one can opt to measure the investment in associate joint ventures by venture capital organization, mutual fund or unit trust separately for each associate joint ventures. So the option of FVTPL has been given in certain situations under Ind AS 28. But there is no clarification that whether this option is for the entire all assets which are investment in associate joint ventures which has been part of this particular bucket, or I have option to separately opt for each associate joint venture. With this amendment, it has been clarified that yes, your option to have a separate election of measurement for separately for each associate joint ventures in the cases which has been qualified to be measured at FVTPL. Ind AS 112, disclosure of interest in other entities. Here it has been clarified that the word which is under read has been only modified in this particular paragraph. Ind AS 112 says that the entity is not required to disclose summarized financial information for the subsidiary, joint venture or associates if it is classified as held for sale. However, the question was that what about the investment, such investment which are a part of the disposal group? As the exemption was only for the particular investment classified as held for sale. With this amendment, it has been clarified that even if the investments are part of the disposal group that is classified as held for sale, then also it qualifies for exemption from disclosure of summarized financial information. Now, with this, we are ending with the very few small important amendment which are brought out by Ind AS Amendment Rules 2018. However, one of the most important change, which is a drastic change as far as the revenue recognition is concerned, is of Ind AS 115. When you look at the principles of Ind AS 115, they are exactly on same line of Ind AS 18 or 11. Prior to 1st April 2018, there are primarily two standards on revenue recognition. One is on Ind AS 18, second is Ind AS 11. Ind AS 18 is for revenue recognition for goods and services, 11 is for construction contracts. Under Ind AS 115, they want to give the comprehensive framework for the purpose of recognition of revenue. If I just make a brief comparison, under Ind AS 1811 there are separate models for goods, for services and for construction contract. While under Ind AS 115 it provides a single model for recognition of revenue, whether it's goods, service or anything else. It provides a 5-step framework and every recognition need to go through this 5-step framework. Under 1811, the focus has been more on the risk and reward. Under 115, the focus is on control. Yes, risk and reward is one of the criteria for recognition, but however, it has been the most important is a control, where the control passes. There has been limited guidance on multiple arrangement, variable considerations, and licenses. Under Ind AS 105, it provides a detailed agreement and detailed explanation with respect to when to separate element, determining control, combining contracts, allocating transaction price, variable considerations, licenses, options, repurchase agreements, and so on. Let us have a brief bird's eye view of the 5 steps framework. First step is identify the contract with customers. Step 2, identify performance obligations in the contract. Step 3, determine the transaction price. Step 4, allocate the transaction price over performance obligations. And step 5, recognize revenue when a performance obligation is satisfied. When you look at this structure, this framework, it has made a very clear and very simple that every transactions or every questions of recognition of revenue has to pass through these 5 steps. Earlier under Ind AS 1118, there was requirement of separating element, there was requirement of fair value. However, it was not clearly spelled out, and the requirement to go through step to step was not there. With this clearly identifiable 5 steps, it is compulsory for each entity to go through and assess the recognition requirement by going to each and every steps. Let's take one example and case study to understand how this 115 is going to make impact and how to apply these 5 steps in practice. Telecom operator Telebig entered into contract with Yuvraj on 1st July 2007. In line with the contract, Johnny subscribes for Telebig's monthly plan for 12 months, and in return, Yuvraj receives free handset from Telebeak. Yuvraj will pay a monthly fee of 200. Yuvraj gets the handset immediately after contract signature. Telebeak sells the same handset for 600 and the same monthly plan for 160 per month without handset. How should Telebeak recognize revenue from the contract with Yuvraj in 2017 under Ind AS 115? Let us look at the each step and identify that what may be the solution. First, step 1, identify the contract with customer. So there is a contract between Telebeak and Yuvraj. 2, determine and identify the performance obligations. What is the obligation of Telebeak telecom operator to provide? 1 is to provide the handset and also to provide the monthly plan. Third, determine transaction price. The transaction price is 200 per month. So 200 into 12, 2400 is the transaction price. Next, allocate transaction price among performance obligations. Now, with that, we need to compare these with respect to the other monthly plans. So, when you look at this, a fair value of handset is 600 and the monthly plans are 160 into 12, and these two fair values are the determining pictures for allocation of 2400 transaction price to handset and also to monthly plan. So here allocation is done by way of transaction price 2400 into 600 divided by 2520, that is 571 is the handset price, and network services is of 1829, that is 1920 divided by 2520 into 2400. And last is recognize revenue when a performance obligation is satisfied. Now under Ind AS 115 there are two approaches. One, you have to recognize revenue at a point of time or over the period of time. Now handset has been delivered, so performance obligation is satisfied at the point in time, and network services are provided every monthly, every day out. So it is satisfied over the period. Therefore, in this fashion, handset of 571 rupees need to be recognized on the date of sale when the handset has been dispatched and delivered to the customer. While network plan is to be recognized revenue monthly basis over the time. Now this is the basic idea about application of all these 5 steps in practice. Now it's a time for the corporates India to understand, identify and plan that how these amendments are going to affect. As 30th June 2018 is the first quarter wherein when they publish the financial statements, at that time they need to ensure that these amendments have been factored into account and then the results are published. In my view, the two standards, two amendments are very important. One need to assess. One is our foreign exchange, where the advance has been received or paid, the accounting thereof, and second is Ind AS 115, because Ind AS 115 is a very important change from the 11 and 18. It requires a lot of assessments for the company to come and conclude. With these brief words, I am thank you so much to all of you for your patience listening, and if you like, please share to support this initiative to educate and promote India's implementation and awareness in India by way of regular webcast, and subscribe to the India's channel. Thank you so much.